The story is inflation is tracking lower than expected.
The Fed kept telling us it's core that matters, it's core that matters. Now that's starting to drift lower.
Apartment rents have been cooling off sharply. We actually, from a seasonality perspective, are set up for a much better Q4.
The historical pattern suggests a little bit more weakness in the weeks ahead, but a year-end rally.
I think this is going to be a buying opportunity.
Levels that you need to watch, starting with the S&P 500.
Rents haven't gone negative in well over a decade. We get CPI next week. What do you think it's going to show? How do you think the market's going to react?
Next week's going to be a turning point for markets in terms of people being more confident. The biggest piece of services in CPI is housing. And I think that's where the market's thinking is changing because, when you look at realized rent indices, which came out and showed actually it's declining now, or the fact that more Fed officials are talking about trying to apply shelter real time rather than backwards looking, the story is inflation is tracking lower than expected. If inflation is falling and companies are becoming more confident, and we already know corporate profit revisions have been positive, that's going to get investors more confident adding equity exposure, but they're going to want to have exposure to companies like the mega cap tech. I think this is going to be a buying opportunity. We know the Fed doesn't want to necessarily apply more pressure to the economy. So if inflation is, let's say, 2.7, 2.8 next year, and Fed funds stays at 5.5, that's extremely restrictive. At the start of this year, people said labor markets are so tight that wages are going to spiral upwards in a runaway fashion that fuels more inflation. We're seeing the opposite. The unemployment rate has kind of been sticky, but all of a sudden it's been easier to fill positions. The JOLTS has been falling. Atlanta wage tracker shows job switchers aren't really getting a premium any longer. I think we're seeing a labor market that's tight, but not one that's adding to an inflationary cycle. If wages stay at 3.5%, even 4%, that's consistent with 2% inflation.
So you don't think the Fed will have to respond to the fact that we've seen energy prices tick up? Doesn't the oil price rise feed into the rest of the economy?
The reason core was introduced was because food and energy were volatile and the Fed didn't want to be responding to those. Oil does matter, but to me, is oil going to cause house prices to soar? Housing and just cars is 57% of CPI. Right? If oil prices cause home prices to jump, then the Fed's got a problem.
What levels are we supposed to watch now?
It is definitely a challenging month for September. The average returns are down 1.16%, and that's as of 1928. Now, that can cause some fears, especially if we're coming up to those oil levels and energy and yields. However, if you pair that with over a 10% gain from January to August, in addition to where we are in the presidential cycle, we actually, from a seasonality perspective, are set up for a much better Q4. Levels that you need to watch, starting with the S&P 500, the support to defend, the major one is 43.25. I want us to close above 44.55, which is that 13-weekly moving average. We're having a hard time and teetering on that right now. However, the main defense line is that August 15th high at 43.25, and then strong resistance 45.45 to about 45.93. But what's so important about all of the major indices right now that I want to bring to everyone's attention is this resistance line that we're overcoming and we're repeating is the January 22 highs support level. And that's why it is so difficult to overcome. And I expect this retraction, but better levels and more expansion, if you will, especially with the productivity and AI as we get into post-September.
I could come on today and argue that a recession is imminent, or I could come on and say we're early cycle. You look at leading indicators in the inverted yield curve, they're flashing warning signs of a recession. But when you look then jobless claims, you look yesterday were very low. You look, we track momentum in economic indicators. You're looking at over 40 different indicators to track how their year-over-year readings are trending. July, which is the most recent data, that was the strongest month we've seen in a couple of years. And it's not the type of reading you see when you're on the verge of a recession. The easy work on the inflation has been done. The headline inflation, it's going to be harder, and that's going to be a longer process getting there. Next week, we're going to see at least 0.5% in headline CPI, but core is going to rise 0.2%. 0.2%. That's going to be, take the year over year to, I believe, 4.3, which is a 2-year low. When inflation was coming down fast, the Fed kept telling us it's core that matters, it's core that matters. Well, now that's starting to drift lower as well. It's going to be a gradual process. You saw Kroger report that sales were slowing because inflation is cooling. You see Walmart lowering entry-level pay. So we're seeing a lot of these things suggest that the inflation pressures are easing a bit. When you look at what you've seen, when you've seen the types of declines in inflation that we've seen, it has been a very positive omen for the market going forward. Do long-term interest rates start, rising a lot more? Do we see a new leg higher? They've been rising in the last few weeks here, but they're sort of stuck in that range, the 10-year, for the highs that we saw last fall and earlier this spring. So as long as we can stay in that level, I think the market can do, just fine. When you look back, take a step back, and you look at how the market's performed this year, it's followed the historical pattern almost to a T. That would suggest a little bit more weakness in the weeks ahead, but year-end rally. The third quarter of the year is the weakest of the 4-year election cycle during this year. That tells us that you could see more weakness ahead, but earnings season just finished up, and we saw decent guidance from companies.
That apartment rent prices are on the verge of going negative.
Rents haven't gone negative in well over a decade, and when they did, it was due to recession hitting demand. That is not the case now. Apartment occupancies nationally are at a pretty healthy 94%, which is right along historical norms. High mortgage rates combined with high home prices keeping people in the rental market. A massive amount of supply. New units this year at a 50-year high, with over 400,000 units coming on just this year alone. Over 1 million new units in the past 3 years. That's a record. Renters have more options. Landlords have less pricing power as turnover increases. While rents nationally haven't gone negative yet, they have in several local markets. Austin, Phoenix, Vegas, Atlanta, and Jacksonville, Florida, seeing the biggest drops.